Mutual funds, index funds, and exchange-traded funds, ETFs, are all types of investment funds that allow investors to pool their money together to buy a diversified portfolio of stocks, bonds, or other securities. A mutual fund is a type of investment fund that pools money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities. Mutual fund is managed by a professional portfolio manager. The funds are typically bought and sold through a broker or financial advisor and are priced at the end of the trading day based on the net asset value, NAV, of the fund. An index fund is a type of mutual fund or ETF that tracks a specific market index, such as the S&P 500 or the Nasdaq. Unlike actively managed mutual funds, which aim to beat the market by picking and choosing stocks, index funds are passively managed and aim to replicate the performance of the market index they track. This means that they have lower fees and expenses than actively managed funds, which can result in higher returns over the long term. An ETF is a type of investment fund that is traded on stock exchanges like a stock. ETFs are similar to mutual funds in that they invest in a diversified portfolio of stocks, bonds, or other securities, but they are traded throughout the trading day like a stock. ETFs can be passively managed like index funds or actively managed like mutual funds, and they typically have lower fees and expenses than mutual funds. In summary, mutual funds, index funds, and ETFs are all investment funds that allow investors to buy a diversified portfolio of stocks, bonds, or other securities. Mutual funds are actively managed by a professional portfolio manager, while index funds and ETFs are passively managed and aim to track a specific market index. ETFs are traded on stock exchanges like a stock, while mutual funds and index funds are typically bought and sold through a broker or financial advisor. Here is a comparison of the fees associated with mutual funds, index funds, and ETFs. Mutual funds have management fees, which are charged as a percentage of assets under management, AUM. These fees can range from 0.25% to 2% or more, depending on the fund. Sales charges. Some mutual funds charge sales charges, also known as loads. Front-end loads are charged when you buy the fund, while back-end loads are charged when you sell the fund. These fees can range from 1% to 5.75% or more. Other fees. Mutual funds can also charge other fees, such as 12b-1 fees, marketing and distribution fees, and redemption fees, fees charged when you sell your shares. Index funds. Management fees. Index funds have lower management fees than actively managed mutual funds because they do not require the same level of research and analysis. The management fees for index funds can range from 0.04% to 0.25%, depending on the fund. Other fees. Some index funds charge other fees, such as redemption fees, but these fees are generally lower than those charged by mutual funds. ETFs. Management fees. ETFs have lower management fees than mutual funds because they are passively managed. The management fees for ETFs can range from 0.03% to 0.70%, depending on the fund. Other fees. ETFs can also charge other fees, such as brokerage commissions, fees charged when you buy or sell shares, and bid-ask spreads, the difference between the price to buy and sell a share. Overall, index funds and ETFs have lower fees than mutual funds, making them a more cost-effective investment option. However, it's important to note that fees can vary widely between individual funds, and investors should carefully compare the fees and expenses of different funds before making an investment decision. When it comes to tax efficiency, there are some differences between mutual funds, index funds, and ETFs. Here's a comparison of their tax efficiency. Mutual funds can be tax inefficient for a few reasons. Capital gains distributions. When a mutual fund sells securities at a profit, it must distribute those gains to its shareholders, who are then responsible for paying taxes on those gains. These distributions can be unpredictable and can result in unexpected tax bills for investors. Turnover. Mutual funds can have high turnover rates, meaning they buy and sell securities frequently. This can result in higher transaction costs and capital gains taxes. Index funds. Index funds are generally more tax efficient than mutual funds for a few reasons. Lower turnover. Index funds are passively managed, which means they buy and sell securities less frequently than actively managed mutual funds. This can result in lower transaction costs and lower capital gains taxes. No need to sell to track an index. Since index funds are designed to track a specific index, they don't need to sell securities to make changes to the portfolio. Instead, they can simply adjust their holdings to match the index. ETFs. ETFs are generally more tax efficient than mutual funds for similar reasons as index funds. Lower turnover. Like index funds, ETFs are passively managed and generally have lower turnover than actively managed mutual funds. In-kind creation/redemption. ETFs can use an in-kind creation/redemption process, which allows them to avoid selling securities to meet investor demand. This can help to minimize capital gains distributions and keep taxes low. Overall, index funds and ETFs tend to be more tax efficient than mutual funds due to their lower turnover rates and ability to track an index without the need to sell securities. However, it's important to note that tax efficiency can vary between individual funds, and investors should carefully consider the tax implications of different funds before making an investment decision.